Welcome to the Whitwam Wealth Real Estate Podcast. Today our episode is the housing market going to crash in 2025?
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
So let's talk a little bit about housing supply and inventory. Inventory is kind of mixed in some different markets, but speaking generally, we still have historically low inventories across the country. Though inventories have come up, we generally would see a larger supply of inventory in a normal market. However, I would say based upon the buyer demand, we actually have a higher level of inventory, a supply, than what we would see in a typical market. And that's not because there's massive amounts of inventory out here, but it's because there is a smaller pool of buyers. Now, every market's a little bit mixed. Your market may be, much different. You may be saying, hey, we've got low inventory, we got great buyer demand. Well, there are a few of those markets here in the U.S., but on average, many of the markets have kind of stabilized. Their inventories are at a place where they're down to 3 months of supply. And then again, others have large inventories where they're at 6 months supply. And there are a few areas where we have much lower supply based on demand, based upon the localization of it. With this, we've also seen, because of the interest rates, we've also seen builders that they have slowed their new constructions. And this is due to several factors. One of them is the excessive days to sell. And days on market in my market are about 90. I think it was 85 on the last report that we pulled from the multiple listing service. 85 days on market on average. That means some houses are selling quicker, but that means there's a bunch of houses that are taking a lot longer than 3 months to sell. Well, if you're a new home builder, you're not going to be wanting to be building a lot of spec homes in order to hedge the market. You want to keep your inventory as low as you can. You're probably not pulling near the amount of permits, and you're trying to build a scarcity so that you can continue to maintain the price you need in order to sell the house. So the excessive days on market and the higher holding costs. I mean, with inflation, everything costs more for new builders to hold on to. If they do build a spec home, and they have to hold on to it for 120 days before it sells, another 30 days to closing, they've got to hold on to that home for 150 days. They've got higher holding costs on the property. Unlike 2008, though, one of the factors I think that is keeping us from experiencing a crash in 2025 is we don't have troubled assets. Which means bad mortgages, people borrowing money that really can't afford it. I remember back in 2008, 2007, 2006, people borrowing money without any down payment. They were borrowing their down payment. There were companies out there charging $20,000, $25,000 just in loan fees to get people into these subprime mortgages. They were doing interest only. They were doing adjustable rate mortgages. And when those things started to come due, there was no way for these unqualified buyers to maintain their mortgages. We don't have those troubled assets. There's some changes that were in the lending requirements, and we're not seeing troubled assets out there like that. It doesn't mean there won't be foreclosures. People run into problems. People lose jobs. People have health issues. I mean, there's still the opportunity for foreclosures, but those are way down. The other thing that we don't have that we had back in 2007, 2008 is we don't have oversupply issues. We're not seeing where there's just a ton of inventory that once the market started to decrease, there were lots of properties for people to purchase, not as occupants, but they were speculators. And these things led, all these things, these wild speculations. So, between troubled assets, wild speculation, and oversupply issues, those were all factors that led to the crash. They often will at least lead to a reset in any market. And you can see that, and it doesn't matter whether it's the stock market, it doesn't matter whether it's the auto industry, whether it's homes. But we don't see those. So it's very different than what we had in 2008. Some other economic factors that we probably should touch on also, right? Since COVID, most of the jobs that were lost have been recovered. Now, I know under the last administration, we used to hear about how they were created 16 million jobs and they created 20 million jobs and all this. Well, the reality is they didn't create any jobs. Those were people just going back to work who had lost their jobs under COVID because the states and the federal government had shut down their ability to work and told them to stay home, and then they would get, their unemployment benefits, they'd get federal subsidies, those type of things. Well, as those started to be shut off, people entered back into the workforce, and we see that the workforce since COVID has pretty much recovered. So, we're kind of back to what I would say a normal employment cycle. We have a constant job market because people have returned to work. Since the job market is constant, it's kept foreclosures low. Even the people who had to defer mortgage issues, most of the banks have worked those out. They've done a really good job at trying to keep, those potentially troubled loans from becoming toxic. And so between the constant job market and the workout of the mortgage issues, we see that there's still very low foreclosure numbers. With interest rates where they are, home prices are a little bit at odds with wages. As I noted under the previous administration, so for a 3-year period of time, we had decreasing incomes that couldn't keep up with inflation, not only on par, but as a totality of income. And now we're seeing growing incomes, wages increasing, growing incomes that are outpacing inflation. But still, it's going to take a little while for wages to catch up with where inflation has taken our new price level. So the prices of homes outpaced wages. So once those wages start to equalize, we're going to start to be able to see that people's buying power will strengthen. This will become even stronger for people as interest rates begin to drop and come down. And most people believe that that's where we're headed, that we're headed to lower interest rates. I don't think we're going to see interest rates again in the 2 and 3s. Maybe we'll never see those kind of interest rates again, but we certainly could see interest rates hit the high 4s, low 5s, which I think would be a very dynamic factor in our marketplace and really turn over some of these houses that sellers have wanted to sell but have not entered the market because of the divergence or the disparity between interest rates. But it'll also bring a lot of buyers off the sideline, all this pent-up buyer demand. And I think there'll be a considerable period of time, whether it's a couple years or it's a full decade, but there is going to be a period of time where the housing market is going to be strong, and I think it will be very good for our economy. There are some risk factors, the things that we can't predict, the things we can't see, the things we really have no way of putting a finger on or throwing a dart in the target on, and that's with public policy. We see courts blocking executive action, things that are trying to reset the economy, manage tariffs, negotiate with countries, bring manufacturing back to the U.S., protect American workers. We see a lot of executive action. We see a lot of congressional support for that, but we see a lot of courts stepping up and blocking a lot of these actions. And so it takes time to run all these things through the court system. But what we've seen on scale with most of these court actions is that the current administration is winning at the final level. They are either winning in the appellate level or they're winning at the Supreme Court level and moving their policies forward. And I think that's the reason why you're starting to see wages come up. You're starting to see the inflation go down, the economics, the core inflationary numbers and stuff down. We're starting to see some pretty strength. We're seeing the government's spending begin to diminish as they have laid off and fired a lot of workers, which means less money that the federal government's pumping into the economy. You see they're canceling grants and eliminating departments, and that's all lowering the amount of money that the Fed is artificially pumping into the economy, which causes inflation. So we're starting to see some tightening on that. Fed policy is going to affect a lot of this. If the Federal Reserve, now we know next May that the Fed chairman will be replaced, but we've seen some board members being replaced at the Fed. If Fed policy changes and they begin to reduce interest rate on the bank-to-bank rate, you're going to see the commercial sector begin to borrow money to build factories, to build businesses. Some of the new tax policy helps them take advantage of writing those things off quicker. The more factories, the more business expansion, the more jobs, better paying jobs, and we're going to see more money, more people able to be in a position to purchase. And the other thing we can't tell about is if, obviously if the Fed doesn't take action to lower interest rates, it'll have an adverse effect. But also, will the banks, as interest rates drop, will they open up their credit or will they tighten credit requirements with lower interest rates? So these are all things that, there's no way to really, be a prognosticator about. I think that at the end of the day that we're going to see, kind of lower interest rates. We're going to see a change in the Fed and their monetary policy and their means for which they look at the economy is going to change. Instead of trailing data, they're going to be more forward thinking. So are we going to enter a correction or are we going to enter into a crash? What is more likely? First off, what is the difference? So a correction is a market adjustment. It can be large or small that resets into the existing markets. So typically when something corrects, whether it's the stock market, let's say the stock market has 1,000-point drop, that could be a correction if over the ensuing weeks the market starts to regain its losses. That's a correction. The market looked and said, hey, price to earnings were off, profits were off, returns were off, whatever it is, whatever the factor is, and it reset. But now it starts to come back. A crash is a market adjustment that continues, steep, fast declines that create new market conditions or norms. So a crash would be if you had that same 1,000-point crash, we'll say on the New York Stock Exchange, and then the next day you had another 1,000-point crash, and the next day you had a 500-point crash. The same thing with the housing market. So housing prices, fall this month, 2%. Next month they fall 5%. Next month they fall another 5%. And it's steep, it's fast, it keeps going on, and it is not leveling out, it's not correcting. That would be a crash. So something that is going to go down until it sets a new market norm. And we saw that in 2008, that we really went down to where real estate was selling way below the cost to build. And when you get down below the cost it is to build something new, then you stop building new, and then people move into taking on, the resale properties, and that'll stabilize it. But, it's typically a deep, fast decline that happens. My analysis suggests that we're headed for a minor adjustment to monetary policy, to, making homes more affordable again. I really think that you're going to probably see a slight pullback on prices. As interest rates go down, you're going to probably see a stabilization of prices. And then what you're going to see is you're going to start to see prices increase as a flood of buyers hit the market. And we'll see sellers who have been off the market come in. There'll probably be for a while a little bit of a balance between inventory and buyers, because we got a lot of sellers who have been sitting on the sidelines, and they're going to be coming in the market as the buyers begin coming into the market. And we'll probably get back to seeing multiple offers, some really competitive challenges for buyers. But again, I think that it's going to be more, I guess, metered and minor adjustments as policy changes. Every market will adjust independently, regarding whether it's price adjustments, days on market, or demand. There's no blanket, but I'm talking in general. I think that's what we'll see across all of the markets. So let me kind of begin to close and talk about, kind of do a little bit of a recap here. So our supply levels, they continue to be elevated. New listings are dropping. as sellers hold off, just kind of waiting on interest rates. Interest rates have eased slightly, but I think we need to see more before we're going to start to see buyers really come back in to the place. There's a lot of Fed speculation that the Fed is going to make some changes based upon their last comments. You never know with Jerome Powell. He has said it before and then not done or not moved in that direction. But the economy is growing, and that's good news for the market. The market should see some correction probably this last part of 2025, but a crash looks very unlikely in my opinion. I don't think we're headed towards a crash in 2025. I think we would already be in the slope of it if that was going to be the case. So here's my advice. Buyers, if you can qualify, buy now while inventory is up and competition is down. So if you're thinking about buying, you can qualify for a property, buy the house now, and when interest rates correct, refinance the house and take advantage of the lower interest rates. You'll have a house that other people wouldn't have been able to get. You're likely to find a house that has more of what you want and get you settled in, and you're not going to be competing with multiple offers and fighting the market. Sellers, wait. If you can wait for 2 Fed interest rate cuts, and just remember the old adage, the best looking homes with the best listing prices sell the fastest. So if you can wait for 2 Fed cuts, I recommend doing that and you'll be good. If you can't, then just make your house the best looking home in the community and price it the best to sell it the fastest. That's the only way you're going to sell right now. Those are the houses that are selling in the under the average days on market. Best houses are the best price. But my real recommendation, sellers, is just wait. Wait till the Fed has cut interest rates 2 times. I'm telling that to our investors also. So investors, when you're buying right now, just know your numbers. This is not a good time for speculation. But don't wait. Start to be proactive now. The key to profits in investing is to buy before the market rush and prices run up. So again, get in the market now if you can. I want to thank you for joining me on this episode of the Witwam Wealth Real Estate Podcast. Check out our previous episodes of related real estate investing topics. I invite you to subscribe today and be part of our growing community. You can always find the Witwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart, YouTube, or wherever you enjoy listening to podcasts. This is Scott Witwam. Be sure to join me on our next episode of the Witwam Wealth Real Estate Podcast, where we're wealth building through real estate.